Yep.
Okay, we're in mock number 2, and we're on question number 1. And the question number 1 brings us back to our days of accounting and gives us a chart showing the EBIT for a 5-year period of a company called EasyJet. And the first question is a basic accounting question, which is asking us, in general, the kinds of adjustments we would need to make to the estimates of EBIT to arrive at free cash flow. And free cash flow, okay, as a reminder, is the amount of cash available to generally service debt. Therefore, existing interest, is not considered a use of cash. Okay, given that, free cash flow is defined as EBIT, earnings before interest and taxes, multiplied by 1 minus the tax rate. We're going to add back to that, okay, which would give us an essentially net income, any depreciation, which has been taken out since it's a non-cash item. If there were any amortization, we would also add that back since it's a non-cash item. We're going to subtract any changes in net working capital, and generally companies that are growing would have increases in net working capital. And then we're going to subtract any investments that we either have made or anticipate making during that time period. And those would be the adjustments that we would make to arrive at the key cash flow for those 5 years. The second question indicates we have no numbers, okay, of our free cash flow beyond 2018. They're asked to describe 2 methods by which we would estimate the value of its earnings stream after 2018, and which do we think of these as more reliable and why? Okay, so the first thing we might do, okay, is use the growing perpetuity formula. Using 430 as a base, we would use 430 as a base, okay, C1, and we would divide that by the discount rate, okay, of the company minus the growth rate of the cash flows. We could get the growth rate of the cash flows, okay, by estimating using a $70 million increase from 2014 to 2018, which is about 70 million, which is about 20%, dividing by 5, we would probably, let's say, we could assume a 4%, okay, growth rate in cash flows, subtracting that from the discount of the company would give us, okay, the present value of the cash flows and the earnings, okay, for 2018 and beyond. Or, okay, we could compare this company to similar companies, looking at ratios, okay, what their projections were, okay, to get, okay, an estimate of the earnings stream after 2018. Which one do we think is more reliable? Probably comparison to similar companies would be more reliable. We'd probably do it 2 ways. We do the perpetuity, then we would do, if they're close, we wouldn't worry about it, but if they weren't close, we would probably go with the most conservative estimate of the 2.
Cool.
Okay. All right, then, once again, our friend Beta has come back, which is almost 100-degree assurance there'll be a question of Beta, okay, on the final exam. Okay, so we're not going to define it in this videotape because we've already done it many times, the beta of a company, though, so we know that. Okay?
Well, let's define it one more time.
Okay, so we'll define it one more time, where beta, okay, is the number for a particular company or the company's stock that correlates it to the overall market. Okay, a beta greater than 1, okay, means that the company is more volatile than the overall market. Less than 1 means it's less volatile.
Okay, and in this case, because it's an airline, obviously it'd be greater than 1.
It would be greater than 1, right, okay? Roughly, given what you knew about the low-cost airline, do you think the beta of EasyJet, okay, and given that EasyJet apparently is in a cyclical business, okay, chances are the beta, okay, would be higher than 1 because it's probably a low-risk, a high-risk company. Okay, then the last question in this area is that EasyJet currently has a relatively low gearing, which is a term I've never seen before, but a British term. Okay, gearing is the net debt to the assets, okay, just over 10%. So they have very low debt, very low debt. okay? And do you think it could add value to the shareholders by increasing its gearing? It could, because by increasing its debt, it is going to have more interest expense. The interest expense will offer a tax shelter, and the company will be able to shelter some of that debt, okay? And as a result, there could be potentially an increase in earnings, which would increase, okay, the share price of the stock by using some debt to get a tax shelter, okay? However, it would, although increase in value, it does add some risk to the shareholders, because all of a sudden now they're increasing its debt. And if they got to an economic downturn, they could run into some problems by paying off the debt. Okay, so that's question number one.
Because they have less cash on hand.
So they have less cash, right?